Growing up, I loved to play the board game Monopoly, but it was really hard to win because my father and my siblings were very competitive. I believe my experience with this board game and the strategies that I observed make for a pretty good story to kick off today's podcast, as the main topic today is going to be about turnover ratios within mutual funds. What are they and why should they matter to you? Believe it or not, Monopoly can help us understand. Good morning and welcome to the HopeFilled Financial Podcast. My name is Jay Disberger, your one and only HopeFilled Financial Coach, and I'm happy that you're here with us today. As mentioned in the opening today, we're going to be talking about the board game Monopoly. When I was growing up, my dad was really competitive. He'd play with me and my younger siblings before we were really at a rational age to think about strategies for a board game as complicated as Monopoly. So he'd walk right over us. One of the things my dad was very good at using Monopoly to teach us was the art of negotiation. He really was quite talented at making deals that looked mutually beneficial, but would help lead him to win more often than not. And oddly enough, my mother would never really play the board game with us because she didn't like the fact that my dad traded. She thought that the nature of the game was to do no trading at all and just play, going round and round and round and round the board until someone eventually goes broke. If this is the way that you learned how to play the game, I'm sorry. I don't think it's near as much fun, and I think it takes way longer than when you are engaging in the art of trading. I know it says in the rules that trading is part of the game. Making deals is sort of a focal point to the game. I'm not going to tell you the best way to make deals. I'm not even going to tell you the most statistically likely places for players to land when it comes to strategy. What I'm more interested in today is the property development strategies for Monopoly. Let's start with a fairly risky strategy my dad liked to implement. Whenever he'd get a matching set of properties or he'd get a Monopoly, he would take all other properties in his possession and mortgage them in order to maximize the amount of cash he had on hand. And really, he would do this so that he could develop properties faster by putting houses or even hotels on them before any of us brothers had a chance. In reality, I'd say this is a go big or go broke sort of strategy, as if it doesn't work and someone else has a fairly developed property ahead of this being implemented or shortly thereafter, you could end up landing on a very expensive property in the game and having to liquidate the real estate that you had developed on the board in order to pay your bill and avoid losing the game. Now, because I don't want to risk losing the game of money in real life, this isn't a personal financial strategy that I take from Monopoly and try to imitate in my personal financial life. I try to avoid leveraging myself, with the mere exception of having a mortgage so that I could get into the home ownership game. Now, this leads to the dichotomy of strategy that I really want to focus on today. Let's say you own two Monopolies, the pink set and the green set. The pink properties being Virginia Avenue, States Avenue, and St. Charles Place. While not quite as coveted as the orange set among my siblings, I have settled and won the game using the pink Monopoly. And if it's been a while since you've played, the green properties are going to be Pennsylvania Avenue, North Carolina Avenue, and Pacific Avenue. Okay, consider this situation. You own these Monopolies. There are 5 of you playing, including yourself, and nobody has any development on any of the properties. It's going to naturally be cheaper to build houses on the pink Monopoly over the green. It'll be $100 per house. Also assume at this stage of the game that you have $1,000 to work with. Now, one lesson that my dad eventually taught me to help me become better at Monopoly was that 3 houses is really an efficient place to be when it comes to property development in this game. Let's take Virginia Avenue, for example. Without any houses on that property, rent is $12. With 1 house, it's $60. With 2, it's $180. But once you get up to 3, it goes up to $500. That first house typically takes rent and multiplies the amount of revenue you get by 4 or 5x. Meanwhile, a second house for most Monopolies in the game will triple the amount of rent from owning only 1 house. Now, these multipliers are great, but we're still starting with relatively low numbers. Now, having 3 houses versus 2 is typically more than double the rent of having just 2. But that's where the multipliers really slow down. You do not double the amount of rent that you have again by adding simply 1 more level of development to any property in Monopoly, at least not to my knowledge. So the point of diminishing returns is arguably right around 3 houses, and in my experience playing the game, once someone has 3 houses, you really don't want to land on that property because that's when the rent starts to look high enough to sting you. Okay, back to the game that we're considering. Remember, there are 4 other players other than you, and let's say they're all getting ready to run up on the second stretch of the board where your pink properties are. Knowing that 3 houses is the point of diminishing returns, you take $900 of your $1,000 and you buy 3 houses on each of these properties. Now, of the 4 other players, 2 of them end up landing on your property. This yields you a profit of $1,000. Now, while this is great, a very active strategy would be to remove some or all of the houses on the pink properties once all 4 players have passed, and utilize the capital you get to develop the green properties that you have. Now, the problem with this is the green properties are more expensive to develop. They are $200 per house. The other problem that needs to be overcome is a rule that not every Monopoly player is aware of, and that is when you destroy a house or sell a house from a developed property, you can only get back half of what you put into it. So we spent $100 per house to make our pink properties work. When we sell them, we only get $50 back from each. We had 9 houses. That yields $450 back. Okay, let's do the math. We had $100 left over from the initial development, and we made a profit of $1,000. Then we sold all 9 houses and got $450 back. That leaves us with $1,550 to develop our green properties. Now, this is where things get a little interesting. We don't have enough capital to put 3 houses on all 3 of the green properties. So we're going to put 2 on 2 of them and then 3 on the last one. Because of where the other players are, and you know that 7 is the most likely number to be rolled, you decide to put the 3rd house on Pacific Avenue. Now, here's the thing. Because there are 3 houses on Pacific Avenue, if one player lands on it, you get $900. If it's the other property next to it, it's only $390 because there are only 2 houses. Now, let's think critically about this. We just spent $1,400 to develop the green properties. If we're going to do the same strategy again, where these get bulldozed, we need to make at least $700 profit in order to make it worth it. This means that we're basically banking on at least 1 player landing on the property with 3 houses, or 2 players landing on properties with at least 2 houses. If this is the case, then we can bulldoze the houses that again exist on the green properties and redevelop the pink ones, iteratively increasing the amount of homes that we're able to put on them until we get to the point where we're moving hotels back and forth. Now, again, this is an active strategy, and it has some inefficiencies, mostly because when you sell a home, you lose half of the equity that you put into it for this game. And in this case, it is a risk. If no players were to land on the green properties after we developed them, and we wanted to move the homes back over to the pink properties, we'd end up coming out behind. See, if I did my math right, we'd only have $850 to redevelop the pink properties, which means we would be able to put 3 houses on 2 properties, and the last one only gets 2 houses. However, it's still possible that we come out ahead. It's a risk, and it's not guaranteed, but you might come out ahead with this strategy and be able to increase your revenue faster from the other players and force them into bankruptcy at an accelerated rate, thus winning the game. But is this the safest strategy? Instead of something so active and something that generates so much overhead expense for us by bulldozing houses and building them, what if we went about this strategy with a buy and hold approach? Let's unwind the game to before there were any houses, and let's put the same 9 homes on the pink properties. And again, we make $1,000 from it, keeping all things the same. But in this particular case, we're not going to bulldoze the 3 houses that we have on the pink properties. We're just going to leave them. We're going to take that $1,000 profit and immediately turn around and invest it into the green properties. That $1,000 is enough to buy 5 houses. Now, it's not quite the 7 homes that we were able to get the first time around, and that means that the property with only 1 home on it, let's say it's Pacific Avenue, would only yield a rent payment of $130 if someone were to land on it. But because we're not bulldozing homes here, that is just pure profit and gain. We don't have to hit a minimum threshold of, like last time, $700 in order to be moving forward with our strategy. In fact, as long as we don't incur a large rent payment ourselves in the game, we're going to be able to continue to come out ahead. It might be a little bit slower, but it's lower risk. Let's say you move forward with this strategy and then try a hybrid later down the road. You get 3 houses on all 6 of your properties, all 3 of the pink and all 3 of the green. Once you have 3 homes on all, you start putting the 4th homes on. But the 4th home, because it's past the point of diminishing returns, is the one that you're willing to bulldoze in order to redevelop the properties, where more players are likely to land in the upcoming set of turns. In this situation, we have our base established before we start taking on more risk. The interesting thing with the nuance here is that it's nuanced, that it doesn't rely on simply being active or buying and holding. It plays a little bit of both. And I think the analysis to see what's optimal is going to be dependent on how many players are playing, what other properties look like, whether they're developed or not, what other strategies are that are being implemented by the other players. And past this point, it gets a little difficult for me to speculate the strengths of different strategies here on the podcast within the confines of this topic. So I'm going to turn it over to you now. What do you think is the optimal strategy? Do you think being active in moving the houses back and forth is optimal, even though it's higher risk? Do you like the idea of buying and holding? Or would you buy and hold up until you got to a certain point that you determined to be optimal and then start moving properties around? And if you're a buy and hold person, do you focus on the pink properties until they're all hotels before even beginning with the green properties? Or do you try to diversify once you hit a point where the principle of diminishing returns starts to eat at you? If you're listening on a platform with a comment section, please let me know below. Now it's time for today's main topic. For today's main topic, we're going to be talking about turnover ratios within mutual funds and how they somewhat relate to our Monopoly example. With the Monopoly game, when we owned a home and we sold it in order to attain the capital to invest elsewhere, we ended up incurring some expense. In the game of Monopoly, you only get back half of whatever you put into a home. Now, this might not be very reflective of reality when it comes to actually dealing with real estate, but it's something that can very well reflect a principle of how mutual funds work, and that's going to be capital gains through turnover. See, when you own a mutual fund, your share of that mutual fund is broken apart into a bunch of different stocks or bonds, different securities. And the ratio to which that mutual fund owns different securities is managed by a fund manager. Now, this fund manager may very well want to change the ratios of what they own, maybe sell something within the portfolio, within the mutual fund, that doesn't seem to be doing as well, or they don't expect to do very well in the near future. Kind of like how in the Monopoly thing, we could bulldoze the houses on the pink properties in order to go develop the green ones. And here's what happens within a mutual fund. When you sell some of those shares, if they have appreciated, you are going to incur something called capital gains. There was a gain that's realized, or maybe even a loss, depending on how the particular security changed. Let's say it's a gain for this example. Let's say it doubled in value. Well, that gain, if it's in a taxable account, is taxable. Just like if you're buying and selling single stocks outside of a mutual fund, when you buy a stock or a bond, and then you sell it within a year, you incur short-term capital gains. And if you were to hold on to a security for longer than a year before you sell it and you had a gain, well, it gets taxed at a different rate, long-term capital gains rates. And this is as good a point as any to remind you that this podcast is not offering tax advice nor investment advice. It's for informational, educational purposes only. Please refer to the disclaimer in the description. Okay, so when a share is sold within a mutual fund of some security, in order to come over and buy a different security, capital gains can be generated. Now, it's interesting. If you're buying securities yourself, trading them around, not within a mutual fund, but on your own, those capital gains would be realized by you. You'd be able to see that cash and allocate it accordingly, either hold on to it or utilize it to go purchase other securities. Within a mutual fund, by default, most of the time, the capital gains are going to be reapplied to the mutual fund to purchase another type of security. To my understanding, because taxes are associated with this, there are certain mechanisms within certain brokerages that allow you to have access to the capital gains generated by your share of a mutual fund. And if that's something that interests you, I'd highly recommend that you talk to a financial advisor to explore that in more depth. But let's get back on track. What does this mean? Why does the turnover and generation of capital gains matter to you? Well, if you are in the taxable account, it can generate taxes. Some funds will do this a lot, moving securities around within the mutual fund a lot. There is a number within a prospectus for any given mutual fund called the turnover ratio. The turnover ratio indicates what percentage of the portfolio is turned over every single year. For example, I've seen some mutual funds where the turnover ratio is over 300%, meaning 300% of the securities that are in the portfolio are turned over every year. But that's more than 100%. That just means that 100% of the portfolio is being turned over every third of a year. So the whole portfolio within the mutual fund is flipped over a total of 3 times every year. That means that if you own this 300% turnover ratio mutual fund in a taxable account, you can expect to be paying taxes on any gains and losses that are realized during the turning over of that portfolio within the mutual fund. You may not have been doing any of the buying and selling yourself, but you're an owner of those securities when you own a mutual fund, so you're just as liable for the taxes therein. There are other types of mutual funds out there, though, that don't have as high of a turnover ratio as the one that I just used as an example. Something that has a low turnover ratio typically is something that tracks in indices like the S&P 500 or the Dow Jones. An index mutual fund is going to have a turnover ratio that could be lower than 10%, meaning that of what you have invested in that mutual fund, you're only going to be seeing capital gains generated from around 10% of it or less, whatever the turnover ratio is, every year. That's the percentage of what you own that you'll be seeing generating capital gains or capital losses, keeping in mind that taxes are only going to be applying to the gain from what's turned over, not the total of what's being turned over. So it'd be inappropriate to say that you expect to be taxed on 10% of a mutual fund investment if there's a turnover ratio of 10%. Some of that turnover is going to be based in the principal amount that was initially invested to buy the security that was turned over. So why does this matter to you? Taxes, in the case that you are investing in a taxable account or a brokerage account. But what if you're not investing in a taxable account? You're investing in a tax-sheltered account, like a Roth IRA or a Roth 401k. Well, those capital gains that are generated there are not necessarily taxable the way that a taxable account is. It's kind of like being able to play Monopoly with someone who doesn't understand the rules that when you sell the house, you only get back half of what you put into it. You can move the security or move the house from one location to the other without incurring that inefficiency, without incurring that tax. And this is because the retirement accounts that are tax sheltered can grow tax-free. Roth accounts grow tax-free. When you withdraw from them, the funds that have accumulated within them are not taxed by the IRS. That's not true for a tax-deferred account. That's true for the tax-free growth of a Roth account, Roth IRAs, Roth 401ks, and alike. If you have a tax-deferred account, you're going to be realizing taxes when you are taking a distribution from the portfolio. But when you invest it into that tax-deferred retirement account, you were able to get a tax break for that given year that you made the contribution to the account, more or less deferring taxes down the road. All this to say, when you're investing in a tax-sheltered retirement account, we don't have to worry about turnover ratio as much when it comes to the tax generation because, well, it's tax-sheltered. There are other concerns that turnover ratio may lead us to want to dig into, but that's outside of the scope of this particular episode. Now, if all went according to plan, this is a shorter episode of the podcast than normal, but the lesson herein is one that's going to build into a much more valuable episode later this year. So I want you to remember this lesson about capital gains and turnover ratios, not just for understanding the tax implications that can happen when you have a high or a low turnover ratio in a taxable account, but the fact that capital gains are still being generated within tax-sheltered accounts, because just the nature of that mechanism is going to be fundamental to understanding a very cool topic that I'll introduce later. So until I get to that episode, and until next Tuesday, budget bravely and enjoy your hope-filled financial future.